Lessor is the owner of the plant, lessee is the utilizer of the plant. For 2 years or 3 years is considered. It's an agreement between the lessor and the lessee's depreciation is called cost divided by life. 5 lakh divided by 5 lakh. 5 is equal to 1 lakh every year it goes on depreciation. It's a form of private equity. We are providing the capital for the individual who wants to invest something. No, what is actually venture capital? No, whatever the value available in the balance sheet is called the book value. Hello my dear students, I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram, First Aid College, a Temple of Excellence, MYSURU. I am going to hand Financial Management 2 Part B, 6th semester BCom, and in favor of revision we are doing. In the last session, I did the revision A. I divide the entire part of Financial Management to 2 groups, Part A and the Part B. In the Part B, I covered about the 3 to 4 questions. In the Part B, I am going to give some more question, which is very important from the examination point of view. It's a revision classes is already done in the same in the YouTube also. So many problems you have solved. I am teaching the revised problem. One problem from the each unit is considered and hope you'll understand that particular points are considered. So we'll move on to problem now. So introduction, key concepts are there. So one problem you have got a problem. One problem from working capital, one problem from cash management, there is cash budget will coming. One problem from working capital financing, where we have got a leasing is there. ABC analysis is there. Economic order quantity is there. All has been covered here. In the working capital financing, no, you have to study leasing. You have to study ABC analysis. You have to study economic order quantity. All things will come here. Then venture capital financing is only theory. Shareholder value creation is also only theory. International financial management is also theory. But they may ask 1 or 2 questions that we are going to solve now. So we'll move on to problem now. So pattern of the question paper, Part A. We'll ask 6 questions. You have to answer any 4, each carrying 5 marks, 20. In the Part B, we'll ask about the 5 questions. You have to answer any 3, carrying the 10 into 3, 30 marks. Part C, they will ask about the 4 questions. You have to answer any 2, which will carry 15 marks. 15 into 2 is 30. Same as the last year pattern also. Pattern will not be changed. You must be very, very careful. So here, theory question will come. Here, theory and practical will come. Here, only practical will come here. So here, 2 theory, 2 practical will come. You must be careful. Here also, we'll ask the 5 questions. Out of the 5 questions, 2 questions are theory, 3 questions are problem. Here, only theory question will be asked. So for that, separate notes will be given to you. No problem at all. We'll give the separate notes for all these things, and we'll move on to problem now. If we see that Vidhya Limited has an annual sale of rupees 5 lakh and an average collection period of 30 days, present 30 days you have got. It is considered a more liberal credit policy. If the credit period is extended, the company is expected that the sales and the bad debts and losses of the following. So credit policy existing, you have got 5 lakh, then it becomes 5 lakh 25,000, 5 lakh 35,000, 60,000, 80, so 5 lakh 35, 5 lakh 60, 5 lakh 80. At present, the bad debt you look after. The selling price is 2 rupees. Average cost per unit is 1 rupee 50 paisa. Out of that, variable cost is 1 lakh 1.20 means 30 paisa is fixed cost. If the current bad debt loss is only 1% of sale present, required rate of return is 20%. Which credit policy should be undertaken? Ignore tax, assume 360 days in a year is considered. So we'll move. What's the format? I'm going to say that first you have to make the sale, then variable cost, contribution, fixed cost, profit, bad debt. So we'll move with the sales now. What is your existing sales now? Your existing sales is 5 lakh. Increase by 25,000, 5 lakh 25,000. And policy N, 35,000, 5 lakh 35,000. Policy P, 60,000, 5 lakh 60,000. Policy Q, 80,000, 5,80,000. So increase by 25,000, increase by 5,35,000, 5,60,000. So here your sale is 5 lakh divided by, what's your selling price? 2 rupees. So 5 lakh divided by 2, 2 lakh 50,000, 5 lakh divided by 2, 2 lakh 50,000 units. Then we have got second one, 5 lakh 25,000. This is policy M, 5 lakh 25,000 divided by 2, 5 lakh 25,000, 5 lakh 25 followed by 30 divided by 2, 2 lakh 62,500, 5 lakh 25 followed by 30 divided by 2, 2 lakh 62,500 units. So next we will go to N. It is 35,000, 5 lakh 35,000 divided by 2, 5 lakh 35 divided by 2, 2 lakh 67,500. Number of units, P, 5 lakh 60,000 divided by 2, 5 lakh 60,000, 560, 560 followed by 30, 1, 2, 3 divided by 2, 2 lakh 80,000 units, all goes in the units. Then Q, 5 lakh 80,000 divided by 2, 5 lakh 80,000, 580 followed by 30, 1, 2, 3 divided by 2, 2 lakh 90,000. This is the number of units. Your variable cost. So variable cost per unit, we can go with your cost is 2 rupees, average cost is 1 rupee, variable cost is 1 rupee 20 paisa. 1 rupee 20 paisa. First one, what's your number of units? 2 lakh 50,000, 250 followed by 30 into 1.20, 3 lakh. This is your variable cost, 3 lakh. Then you got number of units, 2 lakh 62,500, 2 lakh 62,500 into 1.20, 3 lakh 15,000. Then 2 lakh 67,500 into 1.20, 3 lakh 21,000. Then 2 lakh 80,000, 280 followed by 30 into 1.20, 3 lakh 36,000. 2 lakh 90,000, 290 followed by 30 into 1.20, 3 lakh 48,000. Here your variable cost is, see that here 1.20 variable cost, so 1.50, 30 paisa is the fixed cost. So value will come 3 lakh 15,000. First one, this is 3 lakh, 3 lakh 15,000. Then 3 lakh 21,000. 3,36,000, 3,48,000. Deduct. Contribution is 2 lakh. Deduct 0, 0, 0, 0, 1, 2,10,000. Deduct 4, 1, 2, 2,14,000. Deduct 2,24,000. Deduct this 2,32,000 minus fixed cost. You got total cost is 1 rupee 50 paisa, 120 30 paisa, 0.30 per unit. Into how many units have got? 2,50,000, 250 followed by 30. 2,50,000 into 0.30, 75,000. Remain constant. 75,000, 75,000, 75,000, 75,000, 75,000. This remain constant. Deduct. This is 1,25,000. Deduct this. $1,35,000. Deduct 1,39,000. Deduct 1,49,000. Deduct 1,57,000. This is your profit. Minus bad debt. So 1% on sale, 5 lakh, 5 followed by 50 into 1 divided by 100, 5,000. This is 1%. Regarding the second one, 1.5% sale is 5,25,000. 5,25,000. The percentage goes to 1.5. 5,25,000. 525 followed by 30 into 1.5 divided by 100. 7,875. Then this is policy M. Then policy N, 1.2, 5,35,000, 5,35 followed by 30 into 1.2 divided by 100, 6,420. Then policy P, percentage 1.3, 5,60,000, 560 followed by 30 into, what's the percentage? P, 1.3 into 1.3 divided by 100, 7,280. Then 5,80,000, 580 followed by 30 into, what's the percentage? 2% into 2 divided by 100, 11,600. 11,600. Deduct 1,25,000 minus bad debt is net profit is 1,20,000. This is 1,35,000. 1,35 followed by 30 minus 7,8 75, 1,27,125. So 1,39,000 minus 6,420, 1,32,580. Then 1,49,000 minus 7,280, 1,41,720, 1,57,157 followed by 30 minus 11,600, 1,45,400. This is your net profit. Then total cost, variable cost plus fixed cost, 3,75,000. Here 3,15,000 plus 75,000, 75 plus 5, 80 plus 10, 90, 3,90,000. Then 3,21,000 plus 75,000, 3,96,000. Then 3,36,000 plus 75,000, 3,36,000 plus 75,000, 4,11,000. Then 3,48,000 plus 75,000, 3,48,000 plus 75,000, 4,23,000. So this is your fixed cost. So variable cost plus fixed cost is total cost. Then accounts receivable, we can go with this existing account receivable, 3,75,000 divided by 360 into existing 30 days. Second one, 3,90,000 divided by 360 into how many days increase? Here, existing 30 plus 10 means 40 days. Then 3,96,000 divided by 360 into policy N. How many days? Policy N is 15 days, 45 days. Then 4,11,000 divided by 360 into how many days? Here 30 days means 60 days. Last one, 4,23,000 divided by 360 into increase by 42 days, 72 days. Now take the calculator. 3,75,375 followed by 30 divided by 360 into 30, 3,31,312, 49, 31250, 31250, 31,250, 31,250. Second one, 3,90,000 followed by 30 into divided by 360 into 40, 43,333 Then 3,96,000 followed by 30 divided by 360 into 45, 49,500. Then 4,11,000, 411 followed by 30 divided by 360 into 60, 68, 490, 450, 68, 450. I repeat, 4,11,000 followed by 30 divided by 360 into 60, 68, 490. Last one, 4,23,000 followed by 30 divided by 360 into 72, 84,600. This is accounts payable. Return on account receivable, he will give a percentage. Required rate return is 20%. So 1/5 of these, 3,31,250, 31,250 into 20 by 100 means divided by 5, 6,250, 20%, 1 by 5, 43,333 divided by 5, 86,000. It can't be. 43,333, 43 divided by 5, 8667 is the return. 49,500 divided by 5, 9,900, 68,450 divided by 5, 13,690, 20%, 84,600 divided by 5, 16,920, 20%. So surplus of deficit. So this is your return expected. What's the profit here? 1,20,000, 120 followed by 30, 1,20,000. But expected return 6,000 minus 6,250, 1,13,000 surplus, 1,13,750. You call this as B, then you call this as A, this A. Then second one, profit 1,27,125, 1,27,125 minus what's your expected return? 8,667 minus 8,667, 1,18,458. Then next one, what's the profit you are expected? 1,32,580 minus 9,900, 1,22,680. The next profit 1,41,720, 1,41,720 minus 13,690, 1,28,030. Then last one, all surplus you are getting. What's your profit you got? 1,45,400 minus your expected return. Your return is 16,920. 1,45,400 1,45,400 minus 16,920. Surplus is 1,28,480. All surplus. So 1,13,000, 1,18,000, 1,20,000. So the highest is policy P. So highest surplus policy P, policy Q is acceptable. The highest return is come. So same, sales minus variable cost is contribution minus fixed cost is profit. What we have done? Same thing. Sales minus variable cost contribution minus fixed cost is profit. Remain constant. This is a profit. Bad debt is 5,000. Net profit is 1,20,000. Same thing you have to run. Then you have to find out 3,75,000, 360 to 30. That is this we have got. On that 20% will return here. Got it? The surplus will come like this. Among the highest surplus is 1,28,480. That is acceptable. We'll move on to next one. So very good problem here. PQR Limited require a plant for which the following options are available. The plant can be, this is a method of leasing. In the leasing, there are two fellows are. One is called the lessor and is called the lessee. Lessor is the owner of the plant. Lessee is the utilizer of the plant. For 2 years or 3 years is considered. It's an agreement between the lessor and the lessee. I already explained in the last YouTube session. Just I will solve the problem. The plant can be acquired on lease based on an annual rent of rupees 80,000 per annum for 5 years. The plant available at rupees 5 lakh, for which the funds can be raised by the issue of 14% loan. The loan is to be repaid with interest of 5 equal annual installment. The depreciation is to be provided on a straight line basis, and the rate applicable is 40. The depreciation is provided on a straight line basis. 40%, which is a better option. Loan installment is 5 lakh divided by PV factor 3 point. Every year he has to pay how much? 1,45,640. This is your PV factor. So there are 5 steps to be followed. So LEASC means 5 steps to be followed. First, you have to calculate the depreciation. Then you have to calculate the cash outflow. Then you have to calculate the cash inflows. Then you have to calculate net cash outflows and the rental value. These are the 5 factors to be considered. I already explained. We'll solve the problem now. Depreciation. Cost divided by life. Cost divided by life. What's your cost price? 5 lakh. Divided by how many years? 5 years of life. Every year you go a depreciation of rupees 1 lakh. So 1 lakh is the depreciation. So depreciation is equal to cost divided by life. 5 lakh divided by 5 lakh. 5 is equal to 1 lakh. Every year it goes on depreciation. Then this is the first method to be followed. Next we'll move on to what's the loan amount you have got. This is a schedule of loan repayment. What's your loan amount? 5 lakh. Because the plant, you have taken the loan of rupees 5 lakh. Then installment, how much you are paying? 1,45,640. This, which includes the interest. Then 14% interest on rupees 5 lakh is 14% of 5 lakh is 70,000. Deduct 1,45,600. 1,45,600 minus 70,000 is equal to 75,600. 75,600 real money. So for this loan amount, really you are paying how much? 75,600 only. So 5 lakh minus 75,600. So still we have to pay a loan of 4,24,400 we have to pay. Come back here. 4,24,400. Then 14% on this into 14 divided by 100 59,416. Your installment is 1,45,640. 1,45,640. Out of that 1,45,640, 1,45,640 minus 70,000, 75,640. 75,640. Out of that principal money, 5,05,000, 5 followed by 5 minus 75,640, 4,24,360. 360. So here 1,45,640. If we get 70,000, 4,75,000 gone. Here 1,45,640 minus 70,000. 75,640. Here balance is 5 lakh minus 75,640. 4,24,360. Installment money 1,45,640. Interest on this into 14 divided by 100. 59,410. I will repeat. 4,24,360 into 14 divided by 100. 59,410. 59,410 deduct. So 1,45,640 includes the interest of minus 59. 1,45,640 minus 59,410. 86,230. What's your loan amount? 4,24,360 minus 86,230. 3,38,130. Come back here. 3,38,130. On that interest, we'll go through once again. So 4,24,000 is there. 86 there. 4,24,360 minus 86,230. 3,38,130. On that 14%. 47,338. 47,338. 1,45,640. So deduct minus 1,45,640. 98,301. 1,45,640 minus 47,338. 98,302. Deduct 3,38,130 minus 98,302. 2,39,828. 2,39,828 into 14 divided by 100. 3,33,575. 33,575. 1,45,640. 1,45,640. 1,45,640 minus 33,575. 1,12,065. So 2,39,828 minus 1,12,065. 12,065, 1,27,763, 1,27,763, 1,27,763, 1,45,640. He has to pay the principal money. Last 1,27,763 has to pay. So difference is 1,45,640 minus 1,27,763, 17,877. So whatever the difference come, you have to pay. So 17,877 he has to pay. Now, we'll go with computation of division is over. So loan installment, every installment he has to pay 1,45,640. 40% of the interest. So what's the interest you have got? 70,000. 70,000 into 40 divided by 100. 28,000. So 40% of 1 lakh is 40,000. This becomes 68,000. So cash outflows 1,45,640. 640 minus 68,000. 77,640. Discount PV factor at 8.4. PV factor at 8.4. 0.9225. 0.9225. So if you have got 1 rupee, it is valuing how much money? 0.92. So 77,640 into 0.9225, 71,623. So first year. Second year, 1,45,640. So here, your interest is second year, 59,410. 59,410 into 40 divided by 100. 23,764. 23,764. 40% of 1 lakh is 40,000. So 23,764. So this is 63,764. 63,754. 1,45,640 minus 63,764. 1,45,640 minus 63,764. 81,876 into second year discount factor 0.851. 0.851. 81,876 into 0.851. 69,676. Third year, 1,45,640. So this is your 40,000 remain constant. Now, come back to last year interest. So this over third year, 47,338 into 40 divided by 100. So 18,935. So it become 58,935. 58,935. Deduct 1,45,640 minus 58,935. 86,705 multiplied by discount factor. So it 0.785 0.785 into 0.785 68,063. Then here 1,45,640. So this is 40,000. Interest for the fourth year. Interest for the fourth year. 33,575. 33,575 into 40 divided by 100. 13,430. That is 53,430. Deduct from these 1 minus 1,45,640. 1,45,640 minus 53,430. 92,210 into your discount factor 0.724 into 0.724 66,760 last year. 1,45,640. This is 40,000. Last year interest 17,877. 17,877 into 40 divided by 100. 7,151. 47,151. Deduct 1,45,640 minus 47,151. 98,489 multiplied by discount factor 0.668 into 0.668 65,790. Add the figure. 65,790. 71,623. 71,623 plus 69,676 plus 68,063 plus 66,760 plus 65,790, 3,41,912. Net amount, net cash outflow. Then, if you go under list 1 to 5 years, what's your rental value? Rent 80,000. On that, 40% of that, I think is 32,000. 80,000. 80,000. 80 followed by into 40 divided by 100. 32,000. Net cash outflow. 32 plus 8, 40 means 48,000 into 8.4 Your total PV factor will come. Here PV factor. If you add all these PV factor, it is your PV factor 3, first one, your PV factor goes and 3.4331, 8.4.9225 plus 0.851 plus 0.785 plus 0.724 plus 0.668, 3.9605, 3.96 into 3.9605 into 48,190,104, 1,90,104. So conclusion, you are paying how much? This is calculation P of in the cash outflow under release rental value. So rental value is less than your buying option accept lease option, accepted lease option. Better to go it. Then it is a form of private equity. We are providing the capital for the individual who wants to invest something. No, what is actually venture capital? No, there are some candidates who are not in the position to, what's called, he has got intelligence, he is not in a position to have the money. So what the venture capital? No, they will provide the finance by a small business that are believed to have a long-term growth of the potential venture. That means you do not have the money at all, but you have got a capacity, so that money will be provided by the financial institution or a bank to start the capital. That is called your venture capital. It's a means of risk capital which is given by the for individual can have a capacity. He has got a very, very good capacity, but he could not make it because of the financial difficulty. So in the venture capital, they will give the finance at the beginning so that you can utilize your intelligence and improve the company. So if you start the company, we are providing the employment for so many number of people. So types of venture capital. Seed capital means the capital which has been given at the beginning of the year is called seed capital. Startup capital, once you have given a seed capital, then we give some money to start the business, some more improvement will be made to start the capital is there. Then early stage capital, once you have been improved in your stage to purchase the raw material, to purchase other things, some capital will be provided by the financial institution. Expansion capital means, so this capital is provided for expand the business because you are the businessman who wants to start the company for the expansion of the capital. Late stage capital, at the late stage, whatever the capital required, that is provided. So first one, seed capital, then startup capital, early stage capital, expansion capital, late stage capital. Then we'll go to another chapter called shareholder value creation. So here share will be provided to the person, so whose value will be raised in the society. We will provide the finance. You ask you to become the shareholder. So there are two types of share. One is called the equity share, and is called the preference share. So share, it is the value delivered by the company to its shareholder. It is the value delivered by the company to its shareholders are considered. Their value will be raised. Their value will be raised. They will have their own goodwill. So it is a value that the shareholder of a company receives as dividend and stock price appreciation as a result of better decision making by the management. So who will provide? If you become the member of that particular company, your value will be raised. Your value will be raised. Means you have got a shareholder. There are two types of share we have got. One is called equity share. One is called the preference share. Equity shareholders are permanent shareholder. Preference shareholders are temporary shareholder. Everything we have been explained in the YouTube class. Please go through the YouTube that particular YouTube. You can find out. I'm giving only a bird view of that one only. It's a revision class. I have given only just a point I'm going to give here. Other things, you go through the YouTube, you can't understand what we are told about the share value creation. Then you move on to, so here market value added, it is the difference between the current market value and the book value capital employed. Book value means whatever the value available in the balance sheet is called the book value. Whatever the value available in the adjustment is called the market value. The difference is called MVA, market value added. Then we have got economic value added. Economic value added is net profit after taxation minus capital and into WACC means weighted average cost of capital. Capital investment multiplied by WACC. If we go with the problem, so net profit minus capital into weighted average cost of capital, WACC. You take it. What is net profit after taxation? 40 lakh. Minus, what is your capital employed? 5 lakh. Weight will be given 7.6. So it is 40 lakh minus 5 lakh. 5 followed 5 0. 5 lakh into 7.6. 38 lakh. So your problem, expect economic value added is 2. 38 lakh means 2 lakh. So net profit after taxation 40 lakh, capital is 5 lakh, WAC 7 point, it was of course 38 lakh, the excess amount will come as a 2 lakh. Very easy problem you have got. So this is your economic value added. So what is the market value added? No. So it is difference between the current market value and the book value. Book value means available in the balance sheet. Market value is available in the adjustment. Then we'll go to last one, international financial management. It is also called international finance. It's a international finance means we are making the marketing from one country to another country. Our boundary line, your sales selling price will go beyond our boundary line is concerned. We have a good relation between one country to the another country. We can have a foreign market. That is your financial management. Finance is the international business environment. It is trading and making money through the exchange of foreign currency. So you have to make their own currency here. So there is an exchange of currency from one country to the another country, which has been explained in the YouTube fully. Just a touch for this. The value of the country's currency depends upon whether it's a free floating or fixed floating. Free floating means freely can have. Floating means goes on changing. 10 o'clock one rate, 11 o'clock one rate, 3 o'clock one rate. That's called the floating currency is considered. So it includes fixed here now. Floating includes US dollar, Japanese yen, British pound. Other hand, floating based on certain standard. It is a Chinese yen or Indian rupees are considered as a floating charges. No, fixed remains constant, so they won't change. No, but floating based on certain standards are there. Chinese you got, and another Indian rupees also considered. So we take it to yuan from the Chinese and Indian rupees are considered. So there are certain important items I am going to explain. So participate. The international bank, commercial bank, traditional broker. So these are all the personality who helps you foreign exchange market from one country to the another country, which are the participants are. One is international banks has come into forward to exchange your what's called goods from one country to the other country. We have got a good relationship with Australia. We have got a good relationship with America. So we can exchange the goods. So international bank will help you. Commercial bank will help you. Traditional service and brokers are explained. Then there's a word called exchange rate. An exchange rate never constant. You can buy today at rupees 33 rupees 50 paisa. Rate may not hold good tomorrow. Today it may be 33 rupees 50 paisa. Tomorrow it cannot be. Here I have given even a single day the exchange rate, some rate at 10 a.m. one rate, 3 p.m. another rate, one rate at 10 o'clock, another rate late at 11 o'clock, and 3 o'clock the rate may be changed because of the demand. Then there is one word called spot rate. It is a rate applicable to immediate settlement. So if you want to settle now, immediate settlement is called the spot rate is considered. Then you have got a forward rate. This price is decided. The delivery and settlement is made on a specific future date. So you can buy the article today and make the agreement. Your amount will be paid in the future date is called forward date. Then foreign exchange market. Market is a place for buying and selling of currency is considered. This word is important. Bid and ask. The rate at which bank buys a currency is called the bid. The rate of the currency. The rate at which the bank buys a currency is called the bid. The rate at which the bank sold currency is called ask. Buying and selling. The rate at which bank buys a currency is called bid. The rate at which banks sell the currency is called ask. So, buying currency, the rate at which bank buys a currency is called the bid. The bank at which bank sold the currency is called the ask is considered. So, feature of the international financial, one is the currency risk. We have got the transaction risk. We have got translation risk. You have got economic risk. I have explained detail in the YouTube. So currency risk, when you want to exchange from one country to another country, there may be some currency risk there. Transaction risk, when the goods have been transferred from one country to another country, there may be transaction risk is there. Then translation risk is there. Once your goods have been translated, means one place to another place, there is some risk may be arisen. Then according to the country's economic risk we have to face, especially financial management is concerned. So if you have got last 3 chapters, is only theory we are having, no problem will come. We'll give a separate notes for that. First 3 chapter you got a problem. So problem comes from one from working capital, one from cash management, one from leasing, one from economic order quantity. One is called the credit policy. First one, working capital. Second is the cash budget. Then you have got a leasing. Then you have got a credit policy. Then economic order quantity. Then you have got ABC and SC. If you give concentration on this problem, definitely you can score a good marks. Hope my student already have given the model paper also. Now I am doing the revision also. Just I take the subject. So we'll give a separate notes for that. So don't worry, we'll give a separate, our college is so much here now, they will provide a good notes to you so that you can read those notes. Best of luck in the examination. You concentrate, you the student, please concentrate because time is very, very short now. You concentrate one problem on working capital, one problem on cash budget, one problem on credit policy, one problem on leasing, one problem on economic order quantity, and one problem on ABC analysis. Hope you understand and hope you go through the model paper, you go to the revision classes, definitely it will help you. I assure you, definitely it will help you from the examination point of view. Hope you understand what I am saying. Hope best of luck in the examination. Examination is so much near. We have covered all the portion. Please go through one by one. Whatever the doubt here, you can discuss with the teacher. Till then, goodbye. Meet in the offline classes. Whatever the doubt you got, you can ask me. Okay. Best of luck in the examination. Hope you started the studies because examination is so much near. Hope you please go through model paper also, go through the revision class also. Best of luck in the examination. So, hope will bring a good name to the institution and your parents and your teacher. Okay. Best of luck once again.